Hello everyone, my name is Murrell Winter, the owner and founder of SWAN Retirement Strategies. Out of all of our investment managers, we have one of our best investment managers here today. So Catherine Avery Investment Management. Today we have Jeff Cianci, which has 30 years of experience in the industry. He was a former institutional investor on Wall Street. He's now the Director of Research and Strategy at Catherine Avery Investment Management. His career spans senior roles at UBS, Bear Stearns, and he holds degrees from Columbia and University of Miami. Hey Jeff, how are you doing?
Thanks for having me, Murrell.
Yes, sir.
Terrific. This is terrific.
Yep. So kind of want to go over a couple of concepts and ideas because, what's going on in the market with all the tariffs, with all the news going on. I wanted us to just have like a conversation about, what the market is doing. Huge ups and huge downs. Every single day is there's a lot of volatility. But as my clients know, and as you know, a great way of investing for retirement is dividend strategies, where some of the biggest and best companies that have been here a very long time, their track record is that they're going to be here for a very long time in the future. They always have, the ones that we put in the portfolio, they have very bright futures and they also have growing cash flow, and that's what's able to provide more and more dividends to our clients, right?
Yes, indeed.
Yep.
Well, Murrell, I can start with the big picture, which
Right.
is, hey, from my gray hair, you can tell I've seen a number of these cycles.
Right.
This is not unusual to have a market sell-off like this.
For sure.
However, the reasons may be new.
For sure.
You think you've seen it all, and all of a sudden, tariff man.
Yeah.
But if you go back to COVID, if you go back to the great financial crisis, and all these times, that's when we make clients money.
For sure.
It's the old Warren Buffett, where you have to zig when they zag.
Right.
You buy the fear, sell the greed. So we actually were buying stocks yesterday.
Right.
It was a technical sell-off, and dividends are a great strategy in both directions. And let me tell you why. Right now, with things getting better, interest rates are falling slowly.
Yep. That's what we're seeing.
Yeah, tariffs we think is a temporary thing.
Right.
The Republicans are even starting to turn against Trump and the tariffs, and the
Yeah.
voters. Ultimately, the voters and the midterm elections are coming up. So we don't think this is the worst. We think this is the worst, and will only get better.
Right.
We're buying what we call peak tariffs.
Yeah.
It doesn't appear it's going to get worse. Right.
Right.
So the market likes to discount forward, and if that's the case, a lot of these stocks have sold off to tremendously low values.
Exactly.
And the dividends are rather high.
Right.
I think the market dividend now is up to 1.5%, something like that. Our yield in our portfolio is pushing 4%.
Yep.
So we like
That's
to capture
incredible.
dividends, and we like to capture the growth of those dividends.
Right. Yep.
Cash flow drives that.
And that's really, the tried and true method of investing, Warren Buffett approach of buying the biggest and best companies that are growing their cash flows over time. A lot of retirees are looking for more income in retirement. And this is a great solution for them because they can buy great companies that they own, like, and trust. When they walk into Home Depot or they walk into Microsoft or any of those companies, they can say, hey, we know these brands, right? And that's what we're invested in. We're not invested in some unknown company, some small, penny stock. These are all very big companies that have great reputations. So, the other great thing that Catherine Avery and yourself really focus on is companies that are growing their dividends over time. And that can be very powerful because, as we know, the cost of living goes up every single day, it seems like, and then, every year as the cost of living goes up, you can have rising dividends from your strategy to be able to meet that need for retirement.
Indeed. Our dividend, as we said, the yield is close to 3.8%, pushing forward. But the growth in dividends so far this year is close to 7%.
Wow.
And that's in a market like this. And the average forecast for dividend growth this year is much lower at about 3%. A lot of strategists have brought it down. Now, we run a concentrated portfolio.
Right.
So as an analyst, I can know 33 stocks very well, inside out.
Yep.
The managers know, and these are high quality liquid names. So it's a combination of finding the high cash flow that supports that dividend growth.
Right.
You don't want the value trap where the dividend is going to be cut. And
Right.
we've done our best. We've avoided all dividend cuts for the last period. In fact, I don't know if you're aware of this, we made Portfolio Manager of the Decade.
Oh, that's right. Oh my gosh. Yeah.
Based on our last year and then going back 10 years. And I guess the secret to 10-year performance is you have to actually show up for 10 years.
That's right.
Yep.
And be there.
That's where age kicks in.
Yeah. Well, what's very interesting for the viewers to know, back in 2022 when everything was falling, bonds were falling, the stock market was falling into a panic, S&P was down 18%, the tech sector was down 20, 25, 30%. Catherine Avery and Jeff Cianci, y'all's team, was able to come out with a positive return for the year, which is incredible. It's unheard of.
It's the dividend strategy. We keep your money in the down market. There's a thing called yield support. People buy just for the bond yield. We're getting equal to a bond yield. The bond doesn't give you the upside that the equities do.
Exactly.
So defense with offense is a hard combo to play. Defense wins championships, we like to say, and that's why our long-term numbers are superior to our benchmarks.
Right.
But
and that's
with rates coming down, I must add, rates coming down, dividends are going to be even more attractive.
I was just about to say that because, when interest rates are going up, a lot of those investors might say, hey, I'm just going to go to some bonds with a high yield. But then when interest rates start coming down, like we've started hearing the Fed talk about, people start flocking to dividend-paying companies because that's where they're going to be getting the yield and the increasing yield over time. We've talked in the past about some of the positive boosts that the markets might experience. Some are just speculative, but our job is to know everything. Trying to research everything, the real facts. People speculating. News comes out every single minute, and that's what we have to be aware of. So we've talked about a Doge dividend or a stimulus check that the government might want to hand out to families. It's still speculative. There's people talking about it, but it's nothing really solid. That's something that if that gets announced, that could be a huge stimulant for the whole economy. And that's what we saw back in COVID when they started printing billions and billions and trillions of dollars. That's why the stock market rallied so much, was because they knew that free money was about to be handing out. And so we'll see what that Doge team comes up with, what their plan is with paying households, whether it's $1,000 or $5,000 or if there's even a Doge dividend check. But it'll be interesting to find out.
Well, I'll tell you have to mix it though with the debt. The deficit is so large.
For sure.
We need to start paying that off.
37 trillion.
There's a thing, Edward Denny, one of the great economists, used this term, bond vigilantes.
Right.
The 10-year note, when the Fed started cutting, the 10-year note was not coming down because they were worried about the deficit being so high. So if that Doge dividend can go in part to pay down the deficit, then the 10-year note comes down, and that's what mortgage rates are tied to. We start unfreezing this housing market, and then we can rock and roll, as we say, because nobody wants to sell because the difference between the rate they have on their house now and the rates in the market are too high. But if mortgage rates get down to, say, 5%, I think you'll see an explosion of housing activity, which is very stimulating for the economy.
Right. And so with both of our businesses, we don't show any type of political bias, right? We have to just stay with the facts. But something that I was thinking about, why... when it comes to all the tariffs that are being put on all the countries all at once, something that initially I was like, why is this happening? We should have had all the countries around the world have announced that tariff, but China not be put in the picture, right? The reason for that is because if all these other countries would have said, hey, we're going to play ball, we're going to reduce our tariffs, China was on the sidelines, right? Everyone says, hey, we're going to play ball, go with lower tariffs, 5%, 0%. Then that comes into the play with China to say, hey, what are you guys going to do to meet us, somewhere in between, right? But when we announced, when Trump and the United States announced tariffs, on the whole world, that was a little too dangerous. And I think that's why the market has oversold now in the beginning of April, is because it's kind of like the United States versus the whole world, right? And that's just not a good thing. And that's really, I think, a big reason why the stock market has sold off.
Well, I did sign a petition recently for Murrell Winter for U.S. Treasury. No. I think Murrell has the right ideas on how to handle this. But, people are giving Trump the benefit on the one hand, which is, he's got a master chess game strategy here. But if he does not cave on the negotiating with the key countries, China and the U.S. cannot divorce. We need each other's economies. And here's the interesting thing, and we write a market letter that's available to your clients, of course, since we're one of your main managers, talked about the deficit versus the surplus.
Right.
We have a big trade deficit in goods, but in services, America has a huge trade surplus. So the problem with the administration right now is they're focusing just on the goods half of the economy and not on the services. Can you imagine if China retaliates by by putting Microsoft tariffs on software.
Right.
No one's thinking of that.
Yeah.
And so that's why I think this will be settled
Right.
in a favorable manner for the markets. And I'm sure next thing you're going to ask me about timing markets, why we can't wait for that announcement. We've got to be invested in the market.
Right. Yep, and that really goes to one of the graphs that I'm going to show up on the video, where it has these bar charts where it pretty much says that over the past, from 1979 to 2023, if you would have put $10,000 invested in the S&P 500 and you stayed invested the whole time period, that amount came out to $1.3 million, which is incredible.
Yeah.
If people try to time the market and get in and get out and try to, alter their strategy, this shows that if you missed 5 days, just 5 days, all of a sudden your 1.3 million is now worth $847,000.
And the problem is you don't know which 5 days they are.
For sure,
and that's why we must be invested. But we try and do for you and the clients, try and rotate from the risk to the non-risk.
Right.
Our game at the end of the day is risk control.
Right.
We want to keep your money, and as you pointed out so correctly, we did keep the money in the bad markets.
Right.
So you have to view it in the prism of risk.
Right.
And that's where dividends are the right strategy for risk.
Yep. And that's where, finding those companies that are overvalued, right, or properly valued or undervalued, right? And that's where you come together and create that risk changing portfolio that, back in 2022, we're able to have a positive return versus the whole market being down 20-25%. So that's something I wanted to share.
You don't always get credit, like in sports, the defense doesn't get the credit, the offense does.
Right.
So we're trying to play offense when the turn is at, and we're doing that now. We're getting back in. We had a lot of cash going into this, so we're getting back in.
Yep, at great buying opportunities. Something else that I'd like to bring up, we are seeing now that countries are starting to play ball and say, hey, if you guys are going to be increasing this huge tariff, we're going to go ahead and take ours down to zero, right? Think about how that could impact U.S. companies that have had to pay that 10% or 20% tariff, and all of a sudden that goes down to zero. The bottom line for a lot of U.S. companies could rise by 10% or 15%. Right. I mean, we'll see what effect it would have.
It will be enormously stimulative. Of
right.
course, we're doing one dangerous thing in that sentence, Murrell. We're trying to get ahead of Trump.
Right.
Which you don't know what he's going to say next before the good news comes out.
Right.
But eventually, you'll see this in a global boom, and then we focus on the good parts of Trump, which is the tax rates.
Next 2 months, 3 months, we'll see what the taxes come down to.
Deregulation for the corporate world in the U.S. is enormously stimulative.
Right.
And then we've written about something called productivity, where hours worked, output per hours worked, productivity and technology. And we haven't even brought up those two letters yet in this interview, which is AI.
Oh gosh.
AI was people thought it was a fad that came and go. No, it's the biggest revolution we're going to see. It's going to change everything, improve productivity in the U.S. So we're very bullish on this U.S. market. We have to be cognizant, as you point out in your literature, that we're going to have these downturns. They're going to be either short or long, but we think it's short.
Right.
And it's a great buying opportunities.
Yeah, absolutely. Something else that I'd like to bring up, just showing the resiliency of the U.S. equities. I'll show this on screen as well. But all of these time periods where there were, 9/11, COVID crash, all these time periods where it seems like there's no light at the end of the tunnel.
Right.
But there always is. People have to be patient. They have to go through the process. People need to say, hey, this money is for my retirement or for my legacy for the next generation, and I need to let it grow on that time horizon, not try to become a day trader, right? And then another graph that I'm going to show on screen is going to be, 1 day return, the worst time periods throughout history. 1 day 20% down, 1 day 7% down, 1 day 6% down, right? If we look at 1 year later, so 1 year later from those huge 1 day crashes, the average rate of return over the next 1 year time period is 30%, right? So just looking back throughout history, and we know that history isn't always going to play out exactly like it did before, but there are time periods where it rhymes.
History does rhyme.
Yep.
Yes. Look, it's the old buy low, sell high, right? It's hard to make money in the momentum market where you buy high and try and sell higher. People aren't good at that. They chase performance.
Right.
But it's really hard to look yourself in the mirror and say, I'm buying when no one's buying.
Yep.
And that, as you point out in that graph, has proven to be the right move.
Yep, and that's why people, they need to consult with some great financial advisors like ourselves and figure out what would be a great game plan for them and their retirement and for their families. So thank you so much, Jeff, for coming on today. And
anytime, Murrell, and I'm here for your clients. Anybody wants to talk to us, we're happy to.
Absolutely.
Okay, thank you so much.
Thank you so much, Jeff. All right, see you.